Hello to all of our good-looking fans and the three ugly ones. This is Let Me Speak to a Manager podcast. Today is a very cool episode. This is the first podcast episode that Frank and I recorded in the same room, which is crazy to say, but everything else has been via Zoom before this. So Frank and I recorded this in his office in Richmond. This is the story of a $10 million deal that Frank and I put together, and we get into everything from soup to nuts and how Frank found the deal, how I got involved, how we raised the money, how we got through the pandemic with this, and how we ultimately closed and celebrated. So this is a two-part episode. This is part one that we recommend you listen to first before part two. If you are new to our channel, please subscribe, and we hope you enjoy this.
I'm not used to looking at you. I'm used to looking at
Am I freaking you out? Do I intimidate you with my glare?
You're listening to Let Me Speak to a Manager with Frank Cava and Ian Matthews.
What a crock of shit.
Yeah, that was hot mic, Sam.
It's 30 minutes away. I'll be there in 10.
Do it live! I'll write it and we'll do it live!
Frankie!
Ian, you son of a bitch!
Hey man, we're live on location at Cava Companies in Richmond.
We got our wireless Yeti mics. I am really excited about this podcast, Ian. I'm really excited.
First ever Yeti sent us these wireless mics. They're the first of their kind. So testing out new audio this time. This is our 25th podcast episode, and our first one we are doing live on location. So a momentous day.
It's a true story.
A momentous day for our fledgling startup. So
quarter of a century.
Today, what would bring us together for such an amazing event? It would have to be something big, and we, on a number of occasions, have alluded to a deal that we did about a year ago. It was a portfolio, a large deal. And so the title of this episode is Anatomy of a $10 million Deal, which is a juicy, juicy title. It's exciting. I aspire to one day saying Anatomy of a $100 million deal, but for now, 10 million is pretty exciting.
It's a pretty big deal.
Pretty exciting deal. Pretty exciting. So we are talking about a deal that we did together, and we had completely different roles in how we did the deal, and thought it would be pretty interesting to really document how it came to be, how we pulled it off, and how it ended.
I'm not used to looking at you. I'm used to looking at
Am I freaking you out? Do I intimidate you with my glare?
It's a little bit much.
I'll try not to lean in too much. You got coffee breath too.
It's like staring across the ring at Hulk Hogan in his prime.
Without the mustache.
Oh, I would spit all over you. I'm so excited. So, yeah, so this will be a lot of fun. And what I think, like right off the top, why don't we kind of start with like my real estate business and kind of how this thing started?
Yeah, so in general, so both of us play around in the real estate business, and we've been in and out of it. We worked together at a big publicly traded company that built homes for years. That's how we met each other. But since then, you started your own business. You're in the residential space. I'm in the commercial space. So this was different for me. But talk about your business and how it's linked to residential real estate.
Sure. So Ian set up well. We both started off in kind of with home builders. And what I did is I had a non-compete and I morphed. And when I opened the business in 2009, we had I had non-compete plus the market sucked. So what I tried to figure out is where can I make sure that I could get into deals and not lose money? And what I did is I started buying, instead of buying like undeveloped land or things that were very speculative, I bought things that I knew that I could turn very quickly. And I also was very confident of what the asset value was. So the reason I kind of lead with that is it sets me up perfectly to do a deal like this, because these are homes that kind of came across my desk that were already occupied in existing areas and existing neighborhoods, in many instances on streets where we already owned other homes, so I could analyze it. But that's how the genesis of the business started. We mostly do direct to seller marketing and advertising. So someone calls on one of our ads and they'll ask us like, what do you guys do? We buy houses, cash, fast, those kinds of things is what we do for the majority of our business.
What kind of marketing do you do, Frank? How do you get the leads today?
So it started off with like postcards and just postcards. And then it kind of morphed to letters, mostly US mail, like cutting edge technology, right? The US mail. But as we've gotten more sophisticated, we've gone to outbound call, outbound text. We also now will do television. We use radio, and we use internet. So we use both the SEO, PPC, which is like SEO is search engine optimization, where your name comes up so people find you. That's kind of the slow way. The faster way is through PPC, where you pay for an ad and it kind of follows you around the internet. And then we do some retargeting. So if you've gone to our website, we'll follow you around Facebook, for example, to try and buy your house that way. But it's mostly just trying to get one person at a time to sell us a house.
I'm glad you said internet, PPC, and Facebook, or people would think they were listening to a podcast from 27 years ago.
Right.
Because you led with postcards, letters, television, and radio. That's how we do it here in 1957 Kava Companies.
It's true.
Which are still some of your best leads, really. I mean, people have quit on some of that, but that's fascinating.
It's kind of like when I started at NVR, you and I've had this conversation, right? Like I get there and like in college, they made me have a laptop and I go through 9 interviews with Kenny. The last one I finally asked Kenny, I go, you're my 9th interview. Like I hadn't even seen a computer. Like nobody has a computer. He goes, I just use paper. And this was in like 1998. So we don't overcomplicate things.
That's good. It's good. So your business in general, if I could summarize it, you find leads, you try to help people that are looking to sell quickly because you're capitalized well, and you look to acquire single family homes that are at a discount that you could sell, that you could then put some money into, either fix it, flip it, or sell it right away wholesale.
Yeah, so exactly. So we'll get a house under contract, and we think we're going to talk about leverage, right? So a wholesale deal is kind of like, the complicated way to say it is it's like buying an option on a stock. Instead of going out and buying the Apple stock and paying $150 or $200 for that one share, you might buy an option for $5. What we do in a lot of instances is instead of buying a $100,000 house for $100,000, we'll put a $500 deposit down. That's it. Goes to the attorney. We control the asset for 30 to 60 days with just $500. And then what we'll do is one of many exits. Once it's under contract, we can assign it or sell the paper, the contract, to somebody else who will then buy it. We could then buy it ourselves, do the work, and do what they do on television, like flip it and sell it, which we do that a lot. The other thing we do in a lot of instances is we buy it, we fix it, and then we keep it as part of our rental portfolio. And we've got several hundred of those. So the things you're going to start to understand through this podcast that's really important about real estate that I do, you need multiple exits. Because even if you've done everything right on the front end and studied, the market could change, the coronavirus could pop up, the foundation might be bad. Who knows? Neighborhood could go up, the neighborhood could go down. So you need to have multiple exits. And that's what we look at with every deal.
And I think that's a great point that we're going to end up getting into later on. All of those capabilities came to play in this deal. If you were just a savvy investor who was good at buying and flipping and selling for a higher price, just a middleman, this deal wouldn't have gone so well for us. In fact, we'd have lost a lot of money if we'd have done it that way. The fact that you had a property management business, the fact that you had someone who was very good at working with the city, of working with Section 8, of collecting rents, of getting rents raised. You have a department that works with the financing. All of that came to play for us throughout this, and we need to lean on all of it.
For sure. And if we don't have the business that we have in 2019, I never think about doing this deal, number one, because I don't have the skill.
It's too big.
Well, it's not only too big. I know I need to be multifaceted.
Yeah.
So we're going to talk about coronavirus came in right like 3 months into this deal, like we get popped in the face with something nobody had anticipated.
Yeah.
And had I not had Cindy, who works in property management, who's incredibly good at understanding not only property management law and evictions and all those things, but how to go back and she has an attorney who she works with who helped guide us through the PPP Act and the CARES Act. And we ended up going back and collecting like almost $100,000 in rent through government subsidy that we might not have been able to get. That's a huge part of our profit.
Yeah.
So because we had a full suite business with really good people, That's the reason I think about doing this deal. And it's one of the things that I must have before I ever pick up the phone and call, let alone you, any investor.
Yeah.
But then ultimately I pick one of my best friends to do this deal with. Like I need to know that I am properly tooled to do this well.
Yeah. So, but this is, so the deal that we're talking about, the $10 million deal, was 75 properties, all packaged into one deal.
Yep.
Before this, how many large package deals had you done? What first, had you ever done 175 all at once?
Since I've been on my own, no. 75 was a big deal.
Yeah. So prior to that, what was about the largest you would do?
So we did a refinance for 83 units, like 6 months before this deal. So we already owned it, but packaging it, jumping through a bunch of those hoops made me think that at 75 we could handle. We did do one deal, and it was 30 units. And we'd done that about 18 months before we closed on this deal. 18 to 24 months before we closed on this deal.
But aside from that, 90-some% of the deals that you do are one-off.
One-offs.
It's someone gets some marketing. They either saw it on the internet, an ad on you on television. They call inbound to your sales department, who then talks through it, consults with them, negotiates a good price. You go through it in your weekly sales meeting, decide how much would we have to put into it, what could we sell it at, and is it worth buying? You acquire it, you close it 30 to 60 days later. That's your business model in a nutshell.
That is our business model in a nutshell. And what we're really good at is the one-off stuff.
Yeah.
When we did the 30-unit portfolio, we're going to get into this, that almost killed us.
Let's get into it. So when did you do the 30-unit deal?
So we closed on the 30-unit deal at the end of 2017. It got written up in the local paper in the beginning of 2018. And this deal didn't close, the 75-unit deal didn't close until December, basically 31st of 2019. But it was that, can we just get into it right now?
Yeah, talk about the 30-unit deal.
So the 30-unit deal came across my desk from a realtor. It's someone who I've worked with before. I'd never bought that many, but I buy, sometimes I'll buy 3, 4, 5 at a time. I might buy several from one seller in iterations. Like someone's got 5 houses, you buy one, and they say that went pretty well. You buy 2, and then you buy the other 3.
Yeah.
So this realtor that we had worked with, we'd sold him some stuff. We bought some stuff from him. So he's like, hey, I'm pitching this to the market. I know you guys could do this deal. And it started off in like the 40, 50 unit range, but just the numbers weren't right on all of it. And it took time. It probably took 3 to 6 months to whittle it down to it was 29 doors, $3 million. And we bought all of those. But we closed on that in the very beginning of 2018.
Okay, so you closed on it, and that's the first time you ever took that many in. How did it go? Did you kill it?
No, it almost killed us. So it's a true story. It nearly almost killed us. We thought we were ready for it, and we weren't. We didn't have the manpower. We didn't have the staffing. We didn't have the people behind it. Our property management division wasn't in-house at the time. It was outsourced. So there was a bunch of things that went wrong. And then the reason I ultimately called you is we only had debt on that deal, just debt, no equity, so we had we just almost ran out of cash on that deal. And it was the reason I structured this deal in a very different way.
So you've got 30 units. So for someone sitting there thinking about it, you own it, you got the title on all of these. There are, I assume there are, well, you said 29, there are 29 tenants in those properties.
Yep.
Some are paying on time, some are not. You are outsourcing the property management, so someone has to be collecting bills.
That's right.
Because you have to pay debt every month. You have a principal and interest payment you have to make every month.
Yep.
And so if your tenants aren't making payments, it puts a big cash squeeze on your company.
Yep.
Did you acquire those at the right price, or was there some more risk in those properties that you didn't anticipate?
I think we bought it at the right price.
So the pro forma was okay. The price was right. Execution was difficult with that many tenants to manage.
What I learned in that deal is the estimate was wrong. I thought the estimate for the work would be right, but it was higher than I had anticipated. I just mentioned a minute ago that we had to go back through the CARES Act and PPP. On the RVA 7519 deal, this deal, we ended up collecting 99% of the rent that we should have collected. I don't even have the statistic for the 30-unit deal. I would guess it was probably close to 60%, if not lower.
Yeah.
So when you start looking at a deal, it's kind of like a development story, right? When you see a developer develops a 100-lot subdivision, they make their money on the last 12 lots. Like the money in deals like this, you're not as rich as everybody thinks. It's really high level execution, and not only high level execution, it's little details that start to add up. If you don't hit all the check boxes, you can lose money very easily. So on this particular deal, it was a 29 unit package, a $3 million portfolio. What it was, the thing that really kind of got in our way was this. It cost us more than we thought to do the work. Like we anticipated it was going to cost us 20 grand a door. It cost more than that. We thought we could turn the units and get people to cooperate. It took way longer than we had anticipated. So our interest carry and all that stuff went up. We weren't collecting the rents. And then we just had other problems. Like we're spending $100,000 where I had budgeted 25 on a renovation. This is a real part of it. Like I started having cash issues because I was spending way more than I had borrowed it. So you go over budget by 30, 40 grand times 30. It's $1 million. Like $1 million, poof, out the door. That adds up. And we were a way smaller company back then.
And that smokes the profitability of the whole project.
It smokes it, and it just puts strain on not only you personally, but your business.
Yeah. So, okay, so this deal doesn't go well. And if I'm sitting there listening, I'm thinking, well, Frank's got this business. He's had it for 10 years, and it's very profitable, one unit at a time. Mm-hmm. The average person listening to this would think, why wouldn't you just go back to that business model of one at a time? If this went so poorly where you bought a big package and put all that pressure on you and stress, something had to have changed in your business that gave you confidence you could go do something twice as large.
Yes. That thing is, my staff got better. I understood what we did.
So talk about that. So your estimates were way off. So you were not executing well, right? Mm-hmm. You were only collecting 70% of rents, and you had runoffs that were crazy versus what you estimated. So what changed in your organization in that 2-year period to get you to come talk to me about the next deal?
So there's 3 fundamental things that were different. I would actually flip-flop the order, but you asked a question, I'll answer your question. I'll come back to that. I think the most important thing last, which I think leads us down a good road. So first, I overhauled my construction department. I had more estimating help. We studied the deal differently. We said, hey, this looks on the surface like 15 grand worth of work. It's probably closer to 25 to 30 grand worth of work. So our estimates, we just were conservative with our estimate numbers because last time we did this, we weren't conservative and we got killed. So this time around, we were the opposite. We were very, very, very conservative of what we thought the construction numbers needed to be. We went into this deal thinking that we had a couple of projects where we were going to spend $50,000 to $200,000. When COVID happened, we pivoted, but we had the budget built with some of those. So we had some money that we could move from over here to over here in the deal because we built flexibility in. So understanding the estimate and building in some financial flexibility was a big change. That's number 1. Number 2, staff. Our construction department was more robust. We had more project managers. I had changed construction managers who was running my construction department. And I got a magician in there now. Eddie is incredible. He figures out how to get things done. Like when we couldn't pull permits, we had to pivot. We couldn't just pull a permit anymore because the city was closed for 3.5 months. I can't just say, hey, we can't pay the rent or the mortgage because the city's closed. So what we did instead is we just said, we're going to lessen the amount of work we do. We're going to get through this quick. We started to put a real premium on speed versus a real premium on we are going to do what we said we were going to do before. We looked at the path needs to change, but we know we need to get this thing operating, functioning, and we need to pay the investors. Like that was the focal point, not, at the end we need pretty pictures, which is what our problem was before. The third thing that was, I think, the most critical is this, and I think we're going to get into this. That 30-unit portfolio had an average purchase price of $100,000 a door, nearly 2 years before we bought this deal. I bought this deal with an average purchase price of $73,000 a door. I bought it lower. I was not willing to rush into this deal at $100,000 or $110,000 a door because I'd already seen that story. These are assets on the same streets.
So even with a better team, you recognize that at the same purchase price, I'm putting myself in jeopardy of running through the same stress, and I'm not interested in that.
No.
And we're going to get into that on the price points of this. So that's pretty fascinating that you you already knew with the roughly the same type of assets, same houses, same neighborhoods, same zip codes,
Same streets.
I know the pain I felt. This will just be twice as much.
Yeah.
Right. So I'm losing money in every house. I'm going to make up for it on volume. That doesn't work.
You asked me a question. Yeah, right. You can't make it up on volume. The thing you asked a second ago that I think is incredibly relevant is, why don't you just go back to doing one at a time? In 2 years, I did one at a time.
Yeah.
Because like,
that's what you did for a while until you figured out a better model, got a better team.
When this deal was right and the price was right and the people were right and everything lined up, then I knew it was time to do the deal. But it took, I mean, we negotiated this deal for almost 2 years, 18 months to get the price right.
Yeah. So you've got through this 30 unit deal. When did this 75 unit deal first come across your desk, and how did you even find out about it?
So this is pretty interesting, right? So I'm not a marketer per se. I'm a salesman, but I'm not a marketer. And I'm not someone who, like, contrary to all the crap you see me posting on Facebook nowadays, I'm not someone who's comfortable doing that. Like, we've talked about the discomfort for both of us to put things out there on a podcast or, you know, like all that stuff.
As we sit here in a small room talking with 7 lights on us and 2 cameras fixed on our faces.
Yeah, and people staring at us while we do it.
Yes, exactly.
Humble.
But totally uncomfortable.
I mean, it's incredible.
Totally uncomfortable.
But besides that, you know.
The coffee's delicious, though.
Right. So what I did is we had a local marketing company. They do internet ads, they do big campaigns, but they're an ad agency, but they do like all the digital stuff. And I had a relationship with them, and I was on retainer, so to speak. And I just said, hey, I just bought this portfolio. I would like to get some press around it. Like, I don't want to pay for an advertorial, but I would like, there's a paper in Richmond called Biz Sense. I read the Wall Street Journal, the New York Times, and Biz Sense every day. At 7 o'clock every morning, it's somewhere between 1 and 5 articles that just show up in your inbox, and you can see what's happening in the business community. For people in Richmond, the business community reads Biz Sense. Everyone I know. And I wanted to be in it. There's 4 people who are writers, and I didn't know how to get in touch with that person. I could have cold called, but I didn't want to cold call. I wanted to get written up. I thought this was a cool thing. So I hired the ad agency. The ad agency coached me on what to say, and they're like, you're going to speak to so-and-so. So-and-so's really nice, but make no mistake, he's a reporter. So they coached. They made sure that I didn't just screw up and start blabbing or say dumb things that were going to end up in the paper. They're like, have some strategy, talk to him about it, and he's going to ask questions. That's what he does. So
can I hire this guy to talk to you before our podcast episodes to get you to quit saying so many stupid things? I'd like his name and phone number.
Sure.
You can use some coaching.
For no question. But what ended up happening was, I thought that would be an entryway into a bigger market, into other deals, into letting the business community know who we are, because we kind of hung out under the radar until this point.
Yeah.
And what happened was that article got published. Within a week, we got an email. And it didn't come to me personally. I dug it up for this podcast. It didn't come to me personally. It came to our spam account that basically goes through
info@kavacompanies.com, something like that.
Yeah, and Angela dug it up the other day so I could find it. Like I was like, it's not even in my inbox. I didn't save it. It didn't even come to me. Yeah. It got forwarded to me from somebody else because they literally went to the website just to an info spot and said, hey, I saw your article. You might be interested. And when they brought us that deal, it was like a $9 or $10 million offering at first. And it was for more houses, but it was overpriced and it was bigger. And there was a bunch of stuff in there that we ultimately whittled down. But that's how this started. It was with purpose. I went to someone who could help guide me towards getting some publicity. And once the publicity came in, phone calls came in.
So did you get the idea for the newspaper article? Because I know you, and I'm similar to you. You like to kind of let your work speak for itself and grow organically. You're not P.T. Barnum. You're not out trying to over promote yourself. But you had to have gotten that idea from somebody. Something had to have scratched an itch where you thought, I need to go get some press. Is someone from Collective Genius, your mastermind?
No,
that you watched?
I know exactly where it came from. It came from 2 things. Internally, I was like, wow, this is a big deal. Like, it was the first time I thought I did a really big deal since I left NBR. Like, everything had been one-offs, like literally like Ichiro hitting a single to right, like over and over and over. And this time I hit like 3 grand slams. I was like, this feels different. I had gone to a conference in 2009, and it was actually put on by Tony Robbins, and it was all these different people. Gary Vaynerchuk was there when he was a no-name, and there was a woman who spoke. I don't even know her name. I could look it up, but there was a woman who spoke about PR, and she talked about how to get in front of things if it made sense. 8 years earlier, I spent $5,000 to be at an event, and there was a throwaway comment that somehow hung out in the back of my head, and I thought of it then. And then I asked these people who I knew were in the space, I'm like, I've never really done PR. Like, is this warrant PR? And they're like, yeah. Like, we did the whole Omamini podcast about things that kind of build up on themselves and you don't know where it's coming from. Yeah. That's where it was. It was literally planted in my head 8 years earlier.
That's fascinating. You never know where an idea is going to just pop up in your mind. And
that's it.
Where it's going to get used and what it's going to lead to.
Yeah.
So they reach out to you cold. They're asking an obnoxious amount of money. It was something like $9 million for all of the 75 properties, which at that number, that was close to $100 and some $1,000. So that average price
was over. Yeah.
You looked at it and thought, I've been down this route. I'm not touching that. That's $110,000, $115,000 a property. I'm gonna lose my ass. So you say no thanks in a polite way. Did you even meet with their people, or was this all email at the time?
So the first thing I did was blew it off.
You didn't take it serious.
No,
Someone randomly coming through the info at Kava companies is not serious.
It got deleted.
Yes.
Hey, we're so-and-so, and it got deleted.
Yeah.
It made it to me, and I remember going, delete.
Yeah.
I literally remember where I was sitting when I deleted it because I have thought about that. And then that guy reached out again, and I still thought it was overpriced, but he reached out, and then this time he was smarter. He's like, we share a common friend. Gentleman's name is Jeremy. He's like, I went to grad school with Jeremy. Jeremy just so happens to be a friend of my brother's, and I know you through him. I think this could be good for you. He went personal, and because he did that, I felt compelled to call him back.
So you call them back, you have the first set of meetings, that's where the numbers start to get flashed. You say thanks, but no thanks.
And
it doesn't make sense for us.
So we have a couple of conversations, and it's somehow or another, I don't remember the exact details, but we end up sitting in a room with them. And when you're doing a deal of this magnitude, most of the people, we've talked about this, most of the people in my industry are full of shit. They're just full of shit. I mean, Jerome can tell you, they're full of shit. So, that being the case,
well, that's what happens in an industry that is so dependent on debt.
Yeah,
things look much better than they really are, and things are fueled by debt.
So when we started to have some conversations that were somewhat substantive, I think two things happened. I think they kind of showed us that there's a little bit of flexibility in the price, and they didn't really want to get serious with us on price until they met with us.
Yeah,
and this was fascinating. So I'm the owner of a company, but I don't really think of myself that way. I kind of just think of myself as a real estate guy. I kind of think of myself as just a normal dude. And this was the first time, and I've told you this story, that I walked in and I thought the person who reached out to me would be the person I connected with. He's a member of the team, but he's not the decision maker.
So this guy, older version of Frank, who saw himself in you, he was selling 75 properties in the first place just for estate planning. He was getting older. It was simpler for him to pass it down to his heirs if he had cash, or rolled it into a big commercial deal, but didn't want them to have to deal with selling 75 individual properties.
He owned it for 30 plus years, most of these. He's fully depreciated them. Like, their value to him was now over.
Yeah, and we'll come back to that because that's an important piece of what helped us out in the deal is the fact of who the owner was,
right,
and why it was undervalued in your opinion.
Yep.
So you make a little bit of a personal connection in this, but the numbers still don't get real for a while. From the time they reached out to you to the time where you got serious about closing the deal, how long was this negotiation?
It was somewhere between 16 and 24 months.
So 16 and 24 months. So, on one side you say, okay, they offered $9 million. You ultimately bought this package for $5.5 million. Great negotiation, Frank. But the average person doesn't have anywhere near that kind of patience to sit for 16, 18 months until the price comes to them.
Right.
And you were willing to lose it. You probably thought you lost it multiple times. You'd given up on it.
Yeah. If you've ever spoken to a police officer, you've ever noticed like the only people who are police officers that run are on television. And I've asked a police officer that at some point. I said, why don't you run? And they're like, I'm never willing to run into a bullet. Like, that's what this was. I wasn't running into a bullet. I was going to very slowly and methodically do this deal if it made sense, but I was going to walk methodically into the crime scene, not sprint. I'd already sprinted into a deal and damn near got shot. This was not going to be that.
So on multiple occasions, though, you had to have thought, that's done.
No.
I've already walked. I've already said you guys aren't even close. Mm-hmm. I'm just going to go on my business. I'm still making money. I got a good company. I don't need this 75-unit deal. I only need it if it's really priced in my wheelhouse.
So they sent us an email. I remember exactly where I was. Max was like 9 months old. I was in California. I was on vacation. It was August. And I remember I got an email. Angelo got the email. And he called, like we both got it, but I wasn't checking it. And he calls me up like 2 or 3 times. And like when you get a call that many times in a row, you answered. He goes, "You see the numbers?" I'm like, no. He's like, they dropped like almost $1.5 million. And we ultimately closed $200,000 less than that number. But he's like, I think we got the deal. I think we got the deal. Like it was very exciting because but we weren't.
Even up until then, you didn't think they were coming near that. You just were skeptical.
And I bet you they shopped it to other people. Like there's, who the hell could buy 75 houses in our market? There's not very many people. So, I mean, the market was hot, but it wasn't euphoric like it is now, where there was just a ton of cash and people just need to pour it into places. So people were a bit more prudent in purchasing. And this is, let's be honest, this is a heavy lift. So I kind of knew we were competing against ourselves, and I knew if I was patient, I'd either get the deal or I wouldn't, but I wasn't going to kill myself to get this deal.
Yeah. Well, it's interesting when you say that too. A reason why you were able to negotiate it is because of scale. You are large enough where you could handle and swallow 75 units. The average investor who is just good with debt, is good at buying right and selling, wouldn't be able to manage all 75 of these. Because I see that in commercial real estate. If something goes on the market that's in between $1 and $2.5 million, they don't even hit the market. They're just gone because anyone can get debt on that very fast. But when you start going 3, 3.5, 4, 4.5, I'm selling my collision center right now in Orlando for 4.3. And my realtor said, be patient. These take a little longer because someone's not just calling their loan broker and getting a loan for $4 million. We got to find you somebody that can go pay it. And
it's most likely a parcel deal. It's most likely a deal like this where there's some debt and there's some equity. It's more complicated.
Yep.
On our side of the tracks, like we can.
It's a team of people that kind of buy together always.
When we sell turnkey rentals, so like we talk about this all the time internally. Turnkey rentals, if it's over about $100 most people have $100,000 in an IRA sitting around, or $100,000. It's not an insignificant amount of money. I don't want to say that, but it's not a ton in today's terms. Like people have that. Yeah. Once you start getting to 125, 150, that's usually where debt needs to come into play. So with a deal like this, and you asked some of the things that were different between this deal and the last deal, the 30-unit deal, I wasn't as sophisticated as a business. And the market wasn't as sophisticated. And because the SFR space has grown up in the last couple of years. And so instead of using a private lender who can lend me $3 million at really high terms, this time we structured the deal at rates that were in the 7s, which is reasonable. Like you can make money when money is at 7.
Yeah.
So the way that we structured this deal was a lot different. I knew there was a debt component that I could get at a reasonable number. So all that stuff started to line up. But because of it, Ian, like you talked about, the complexity was big. So we kind of had, we were one of the few dogs in the fight. And because the market had come back to us, it was more affordable.
So you arrive at a price for 75 units of $5.5 million. You sign a contract, you agree to terms, you now have to figure out how to finance it. So in the past, you've used different, you have 10 or 12 lenders that you go to regularly, all different tranches, depending on how quick you need the money, how fast you're going to pay them back, what kind of terms they're getting, right?
That's right. So
that could be anywhere from 6 to 10%,
yeah.
With a hard money lender. On this particular deal, $5.5 million, this is not the only deal you have out there. At this point, we were talking about this at the time, you had multiple layers of debt on other properties that you own. You own over 300 properties right now?
Yeah, over 300.
Yeah, 300 properties. So you've got debt out there that's strategically placed. So you're looking at this deal and you think, okay, I got to figure out how to do it. And financing all of it based on where your assets were at the time was a non-starter. You had to figure out a different approach.
Yep.
How did you decide to syndicate with private capital? And syndicate just means collect money from people that are not banks in a simple way.
So I want to pause for a second. I want to define something. Like if you're you and me, or if you're someone who listens to a lot of finance stuff, like you understand what we're talking about. But I think it makes sense to clarify this. So Ian said a second ago that I had other debt out there. It's absolutely true. So I'm going to make the math real easy. If I buy a house for $50,000 and it requires $50,000 worth of work, I'm out of pocket somewhere between $10,000 and $25,000 to do that house. So the purchase there is debt. I'm going to do that with debt, but I also have to come to the table with equity, somewhere between $10,000 and $25,000 worth of my own money. So I have all these projects going on at a time, and this is what I did wrong in a 30-unit deal. I didn't raise equity. I used my own equity. So my life got real tight because I had all of this stuff going on and I didn't have the cash to float it because I needed my own internal cash.
Yeah.
So there's debt, then there's capital. Your capital is your down payment, or it's your equity. Usually it's referred to as equity if you bring it, if someone else brings it to the table. So if you do a $100,000 deal and I come in with 80 and Ian gives me 20, what Ian wants for that equity, so to speak, is he wants a return and he wants some points on the back end. So I didn't speak this language when I got into business for myself. Working at NVR, I knew how to structure deals, but not like this. So I had to, and we've talked about this on the podcast before, I had to understand how do you structure the deal. I was at a different seminar. I love to learn. You and I love to read. We talk to people. We're always out kind of finding information. I just so happened to be at my friend Tim Bratz's event. It was in Florida. And I have this deal under contract. I've already written the check for the deposit, which we're going to get into. And I didn't know how to do it. I just didn't know how to do it. And I was trying a bunch of things and I was gyrating and it just didn't make sense. And Tim was going over a commercial deal. He buys multifamily housing. So he buys apartment complexes. And he told me how, like he was explaining to the whole, it's 400 people in the room, how you do this deal. And like, it was like a bolt of lightning. I was like, that's it. Like, that's how I'm going to structure this deal. Like, I got up, I ran out, and I sat on my phone, and I texted myself, like, this is how I'm going to structure this deal. So, like, the second day of the conference, I'm like, I got it. And I had a business coach at the time. Like, that afternoon, we had a call. I'm like, I'm so fired up. And he was walking me, like, asking me a bunch of questions. And I was like, this is how I'm going to do the deal. I didn't know you were in the deal. I didn't know all the pieces, but I knew the structure. Like, the structure hit me. And within probably 3 days of that meeting, I was on the phone with my attorney and I said, hey, can we do this? He goes, absolutely. I've done it all the time. I don't know why I didn't just call him first, but this is how these things work. I called him up. I said, this is what I'm thinking. And we ultimately kind of on a cocktail napkin laid out the deal that I brought to you. Between concept and reality, it changed. Some of the details.
So talk about the deal on the cocktail napkin. As simple as you can.
Yep, easy. I have a debt component on this deal. I'm going to raise equity on this deal. And the way that Tim does it, he raises equity past the point of what the purchase price is. So he doesn't run out of money, which almost happened on the 30-unit deal. Then I was going to charge myself a bunch of fees. I was going to sell it to somebody else. We were going to manage it. And then we were going to charge a bunch of fees. But what I ended up learning is, so in its simplest form, we were going to buy the deal for a price.
It's $5.5 million sales price.
That's right.
You needed $2 million of equity from outside investors.
Yep.
And you were taking a loan out of what?
So let me back up. It was a $5.5 million purchase, and I charged a $2.5 million fee. So it became an $8 million
So $8 million
deal.
purchase price.
That's right.
At that point, $2 million of it equity, $6 million debt.
Yes.
Roughly.
Yeah.
Roughly. That was what you were thinking it was going to be.
Yeah.
And to do that, you had to form an LLC
Yep.
that was going to acquire the property. It was not going to be Kava companies.
That's right.
We would have a service contract with you should you pull that off.
Yes. And I didn't know you were the guy yet. Like I hadn't thought, like this is probably 30 days before I called you, where I'm just conceptualizing this deal. But exactly, that's how it all starts to come together. And what I thought of is this is very similar to my buddy's apartment buildings, just 75 singles. And by taking a huge chunk off the top, I made a profit in the year that I wanted to. I've gave myself enough cash to do the deal where I knew I wouldn't run out of money. It gave me the ability to grow my staff. Like there was a bunch of things that we ultimately talked through, but that is how it started to come together. But I think the lesson that we're going to talk about is we're going to talk about how much I paid in deposit, which is pretty low. I'm going to talk about, I didn't really know how I was going to get this thing closed when I put it under contract. Like I knew I was going to close, but I didn't completely know like what it looked like. Like, am I going to assign all of it or part of it? So there was a lot of uncertainty. I knew that I was going to do the deal and I knew I'd figure out a way to make it work, but I didn't know exactly what that looked like when I started.
Makes sense. Okay. So you have it sketched out. You've had your eureka moment. You've talked to your attorney to see is this legal, which is important.
Yeah.
You've got now a clock that's ticking. You've got what, 60 days probably in the contract of when you're supposed to close. I'm sure.
I gave myself, I think like 60, 120.
Yeah.
But I had I had months, not years to close.
You had months.
Yeah.
Yeah. Cause you'd already burned through some trying to figure out how to finance it.
That's it.
So that's about when I come into this deal. So how did you decide to call me, who has never done anything like this before?
So again, there's analogies you hear all the time. You've never seen the movie The Social Network, but The Social Network, Justin Timberlake convinces Mark Zuckerberg to move to the Bay Area, and they move to the Bay Area because he just needs to kind of be there. And being there, like there's engineers and people you bump into, like being immersed in it changes things. So I'm immersed in this, like I'm fully immersed in this. And the reason you came to mind to me is I was out walking a property. I remember where I was going to get out of the car and I was just sitting there talking to you and you were telling me about your second collision center and how you're raising equity. You told me some of the people you were talking to. You're talking to me about the rates. And I remember you talking to me about like, you know, how much money the people had and they were excited to deploy it at rates that I thought were very reasonable. You and I talk. Like you and I had talked about this deal 12 months, 18 months
Yeah, you've been
earlier.
asking me about it, what I thought about it a bunch of times.
Yeah, and I never knew you were going to be involved in this.
Yeah.
So you and I had talked about it a fair amount. So I thought of it this way. I thought this could be a future deal. Hitting a bunch of singles is great. Like it's made me a great life. This is a much bigger lift. If I was to partner with you, I thought you had the wherewithal to understand it. I knew we trusted each other and would think our friendship was really important and we're going to figure out how to get through this. So I knew it wouldn't be like me managing someone or someone being a tyrant over me. I also knew that you had a gift for writing. This was something that was really important to me. I thought you would communicate it very well. I thought you would be able to tell the marketplace what we were doing, and I thought I could share that story again because I saw this as being replicatable. And if I had the right group of people, you, to write up a story, like, holy crap, this could be something we could share. And I've sent those emails since to other people that just, so those were some of the components. And I'll switch and I'll start asking the questions now. Do you remember the first time I called you? We'll start here. Do you remember the first time we ever talked about this deal before I brought it to you as kind of an investor?
Yeah, you know what? It's funny. It was from your 30 contract deal, though. I remember a picture you sent me of you smiling. You were at it might have been this conference table. You had 30 packages in front of you that you had to sign. I remember we had a long conversations about how exciting that was for you to be doing a deal that big. And, and I remembered multiple conversations along the way. You were frustrated with some people on your team at the time because that deal that you had such high hopes for was going south in multiple ways and you were frustrated. And we talked through that a lot, right? So a lot of I had an intimate look on the inside of what you were doing to really reimagine your entire company and your team because of that 30 deal, the lessons you were learned. So I do remember when you started saying, I think I'm about to go do something again. And at first you were joking about it, like, well, here we go again. I'm going to go do that, all that, because I remember the stress you went through.
Yeah.
And that was all like right around you getting married, all of that. It was, I remember it all.
That 30-unit deal I used to think about every night when I gave Max a bath.
Yeah, you were stressed
every
all the time. Night. Yeah. So I remember multiple conversations about the 75-unit deal and thinking, he's not going to do that. He's a new dad. He doesn't want to do it. So I would listen, but I think that's pretty awesome that you have that opportunity. But I vaguely remember the first conversation when I thought it was serious because you mentioned your attorney and you mentioned a fee. And I think that's the only time, like we talked about it a few times. You're like, here's where I would structure. And you kind of vaguely brought me up, but it wasn't a real hard sell. I think you were trying to just drop like the fly fish into the bait into the water, see if I would nip at it.
Right.
But when you brought up like, well, here's a fee that we could do. Then I was like, oh shit, I think he's presenting this. He really wants me to go do this. But I remember it was like everything in life, it wasn't one call to close me. It was multiple slow, what do you think of this? What do you think of this structure? It wasn't, the first time you brought up the structure to me was not when you said, I want you to be the manager. It was just, what do you think of this structure?
Yep.
That's what I remember is I think you were trying to see what my thoughts on the idea in general were.
Before I brought this deal to you to pitch it to you, we kind of have talked at points about, I think we're going to get into it, like who we rely on for information. Like I rely on you for information. Like I talk to people like very candidly about you're one of my secret weapons, right? Like I go ask you questions about things I'm dealing with, personnel, management, investing, because you see that. So when I had brought that to you as an idea, you didn't immediately kill it. When I started thinking about who do I want to do this with, you were very high on the list because of the way that you had reacted, but I didn't bring it to you as a pitch when I was serious about the deal. I more brought it to you just to kind of run it by you.
Yeah, that's how I remembered it.
How did you know, well, I guess you kind of answered this, but like, how did you know that I was either serious about the deal or I was bringing it to you to be like the manager?
Well, one, you brought up a fee schedule of how it would work for me. So what would be in it for me? Because I think after a few calls, I remember getting off one of the calls thinking, yeah, I think I'm going to invest with Frank in this deal. I still was thinking you just wanted me to be part of the $2 million. So I was thinking, okay, yeah, I'll put a piece in there. I have some capital I could use. But that next call when you said you would be the manager on the LLC, that's when it all got serious for me because, to invest passively is one thing. You're a passive investor. You don't really have any liability. To be a manager on an LLC, you are now liable. You are now the guy that gets sued if investors are not happy with the way something goes, right? There's a very different connotation to be on an LLC and to be the manager of an LLC. And I knew that. And so I think that's when that conversation got very serious. And that conversation is when I started asking you a lot more detailed questions.
So I remember this incredibly well. So Eddie, Angelo, and I had gone to a conference. And we were sitting in my car, and we put you on speaker. And I don't know if I told you they were in the car or not, but this was like the part in the dialogue where you and I were getting into the nuts and bolts. And I remember saying this. I said, Ian, you seem interested. And you said, yeah, I'm interested. I was like, but you also seem to have a lot of questions. Why don't you... Did I give you an email first with like an overview, or did you ask me the questions? I think I sold it to you verbally, and you asked the questions, and I came back and did a bunch of work.
You sold it verbally, and I had a lot of questions, and some of them you didn't have answers to yet because you were still trying to figure the deal out. So I think I got 4 or 5 into my 25 questions, and you were like, pause. You have more than that. I know it. I can already tell. And I think you knew at that point, if I'm asking those kind of questions, I was serious about it, but I needed more detail. And we talked about this later. You didn't know this about me at the time, but people either learn by listening or they learn by reading. And I'm a reader.
Right.
And so, I didn't tell you this at the time, but this is when it became serious for me. I said, look, I'm going to give you a big list of questions. I can do that. I need to see it all laid out in front of me because I can't, my mind just, if people call me and start launching into something new for me, I start to hear the Peanuts teacher. I start to hear wah, 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 wah. I don't hear the details. A lot of times will pause and say, hey, can you send me an email with everything you just said? Because I'm sorry, you lost me after 11 seconds.
Yeah. So for those of you that are watching, this is double-sided and this is like 12 pages. So these are the questions that Ian had started with. And it started with the first email was, it was 12 questions in length. And it was, how do you feel, starting off with, how do you feel that you can separate Kava from this other entity? And it was some like real mathematical type of questions. And some of it was, just philosophical type of stuff, like how you can do it, blah, 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 blah. But I remember I got your questions and then I replied to your questions. So you sent it to me. I replied almost a week later. So I called you up.
My guess is you wanted to talk to Sack about some of them because some of them you hadn't thought through.
And I didn't want to be wrong.
Yeah.
Like I saw that you gave me your questions. It took you about a day to give me the questions.
Yeah, I put a lot of thought into it.
And then I called you and I said, look, I can answer this in a haphazard way, but I can answer this thoroughly in about a week. And what I did is I went through and did a pass. Angelo and I did a pass together. He types at like 900 words a minute. So I don't know if that's an exaggeration or accurate, but he's real fast, a lot faster than I can do with these things. So I just put my sausage fingers up for you, those of you not watching. So he would type. We put together our answers. We took it to our attorney. We had him, and our attorney isn't just an attorney and say, hey, you're getting into trouble. Our attorney is a business guy. He's someone who does mergers and acquisitions, so he knows how to do deals. So I brought it to him with, does this make sense? Am I answering this right? Is this in the spirit of what we're doing? Like, I think we can get real granular. But instead of getting real granular, what I think makes sense is this. When you're trying to do a big deal with someone, you need to be brutally honest. You need to talk at a level that is just blunt, honest, and it's stuff that you can stand behind. In addition to that, you don't want to run into gunfire. You want to slowly and methodically answer things because you need to do it properly and right. You don't want to make a mistake. You don't want to turn the person off. So I saw your list of questions. I knew what would go into the answers. I remember calling you and saying, I would like to reconvene in a week. And when we reconvene in the week, I will be thoroughly prepared. And Angelo and I spent like a full day and a half answering all this. We set up a conference call with our team of attorneys. They went through it with us. We iterated it again. Like by the time I spoke to you a week later, this is the only thing I had worked on. Like This was it. Because I wanted to be prepared. I wanted to have an answer to everything you asked. If you asked a pivot question based upon something, I wanted to know why I typed what I typed. So this is a $10 million deal. There's bigger deals out there, but this is a huge freaking deal. And you've got to be versed and ready for some, like when you bring this to someone, because there's a lot of risk. Like things could go very wrong.
So I think the risk side, I think it's worth talking about here for a second, because yes, it's a $10 million deal. So from your perspective, there's reputational risk, there's execution risk. You could lose money on it. You could upset a lot of people. And then on my side, what my value of the deal is my reputation. That's all I was bringing to it at the beginning. So I knew if I was going to say yes to you, my next job was to get on the phone and start calling people and asking them for a minimum of $250,000 of their own money.
That's right.
To put into a real estate deal with you.
Yep.
Those questions I had to have every single answer to. So part of my list of questions that I got you started with 12, and that 12 led to another 12, and there was a lot of detail into it. But some of it was for my own money. I'm protecting myself, so I need to understand, I worked hard for $250,000. I don't want to lose $250,000. But much bigger for me, because I know you, and it probably wouldn't have taken that many questions. If I'm going to then go promote your deal, I need to know it's ethical, it's legal, it's effective, it's fair for the investors. There's a very good chance of them getting their money back, because the people I was going to call, yes, they're wealthy, but think about the folks I called. I built relationships with these folks over decades.
Yeah.
And so one bad deal ruins a relationship for me.
That's right.
So my anxiety around this deal was really my reputation, right?
Yeah.
And I had, you'd mentioned it. I had done multiple syndications, commercial real estate, and I was doing a great job. And, I knew that side. I knew triple net, commercial real estate, industrial equipment rentals. We had this conversation at one point where we were going back and forth, and I said, Frank, I'm just going to be real honest with you. I can probably go get $2 million out of this group of people, and I could go buy another collision center. So I need to understand why I'm doing this and not just getting that $2 million from them and doing a deal that I know I'm going to take care of them on. And we kind of, I had to tell you that, like, there's competition for this 75 portfolio that I understand better, So you have to get me to a place where I really understand 75 single family homes, because I don't get it enough yet. We talked about that in detail, and that's just inexperience. Now I understand it a hell of a lot better today after going through it with you. But at the time, it was kind of like, well, Frankie, I could do a fourth deal with the same group of people, and I know exactly how it's going to turn out. I just know it, and I have a team that could kill it with that. So
I think there was two things that I said to you in that. Do you remember what my response was to that?
No, I think you understand it. And actually, a few terms changed in the deal. I think on a piece of it, there was a profit split change for me where I was just telling you it's just not that juicy for me. I need some payment that's not just, why don't I just invest in this, is what I said. I'm putting my reputation on the line. I'm a manager. Why don't I just tell people to call you and we all invest in it? Because if I'm not doing much better than an average investor, then why am I taking all the point? What the hell's all the point of that?
Right. So there was two things that I remember saying to you. One of them was, on this deal, Ian, clearly I need to get you more answers. And that's why I talk so much at length about getting you incredible answers when I did. The second thing I remember bringing up is you and I have talked many times about starting a podcast, which we finally have. And we also talked about potentially starting a trust or a fund, a trust. And if we were to start a fund, we need a multitude of investments in it. You're really good on the commercial side. You're really good with the collision centers. I'm really good at this side. If we have a blended basket of assets, it gives us more to talk to investors about. So we had both sides of it. And
that was a good selling point too, in that when we talked about it, I think at some point we both came to the conclusion that if we're going to build a real estate fund one day, a serious one,
you need to do something
we
together.
Need to do a deal or two.
Yeah.
Like, we need to tell people we've done some deals, not just Frank and Ian are great, you should buy our fund.
Yeah.
We talked about this. We're like, we need some deals. We need some wins. And that led to, Frankie, is this the one? Right? Because then it was like, look, we're never going to do a real estate deal. We're never going to do a fund if this isn't the deal. Is this the one we start with? And I think, take all this stuff aside. So you were getting this big fee up front, and you needed that fee to go bolster. You hired some people with that money. That $2.5 million didn't go right to the bottom line. You hired better people. You spent a lot of that money. But one of my sticking points was, you're taking all your profits up front. Mm-hmm. And then you're layering in, you had like property management fees. You had some other things I didn't like. And I said, look, if you're going to take that huge fee up front, you can't be making fees on every deal.
Correct.
And you were like, fine, they're out. I can make money without that. And the other thing I said is, you need some skin in the game. You need to be one of my investors. And then you took it a step further and you brought your brother into it. And all those are like terms of the deal. So those are some of the sticking points in the legal, the LLC, all that. But you get lawyers and they tell you, well, you get off the phone with a lawyer and you don't know whether you have more risk or less risk. What it comes down to at the end of the day for me, and in doing business, more than all of the little details and the questions I asked you, I needed that to go sell other people. But what it came down to was, I just trusted you. I had a serious conversation with you. And after all of that detail, I said, Frankie, you know who I'm going to call. And you do know who I was going to call.
Yeah.
Like, these are important people to me. And I would rather lose a freaking arm than go lose them $250,000.
Yeah.
Is this the deal? Do not make me an asshole in front of some of my best friends. And you were like, I totally get everything you're saying to me. I'm putting my brother in it. I'm putting my own money in it. I don't need to be losing my brother money. This is the deal. Like I was really, in a term that I used all the time, which always made you laugh every time, is what if this deal goes tits up? Like, tell me what's going on. I kept saying that over and over to you. And you looked me in the eyes and you said, Ian, this is the deal. This is the deal we start with. I'm not going to put you in that position with your friends.
Now that we're, I don't know how long into this, an hour into this podcast, that we really want to name this podcast Tits Up.
Tits Up. What if it goes tits up?
But we won't. But that was one of our favorite things to say during this whole deal. But we have done a podcast, several of them, and we've talked about decision making. We've talked about it's not the deal, it's who's the jockey. We've talked about the Colin Powell 70-40 deal, right? So this was a deal where I fought over it for a long time before I ever thought about doing the deal. And I certainly knew there was risk, but I also felt very, very comfortable with the risk. And I'd already made mistakes in something similar, so I knew how to structure this differently. The things that I felt very comfortable with is I had done that 30-unit deal. We made mistakes. I had assets on the same streets. My team is better. We had multiple exits. Like, we could turn these into rentals. We could flip these. We had all kinds of different options. And that was part of it. So that fulcrum of, should we do the deal? Should we not do the deal? Are we going to lose money? And I know most of the people who were invested. Like, I think with the exception of 2 people out of 8, I know them all. Like, I consider them friends. Like, I don't want to lose this for them. One of the things that I pride myself on is, I've been at this for 12 years. I have paid everyone back. Always. Every penny. Always. And I remember thinking to you, Ian, this deal, if it goes sideways, I will either lose my investment. I became to get in the nitty gritty, I was a B shareholder. And I think we came to that conclusion, like, universally, right? Like, I get paid last. Yeah. And that's how we set it up. So if anyone loses money or anyone doesn't get a return, it's me. And on a deal of this size, like, that's like $600,000-$700,000 with return factored in. That's a huge insurance policy. Yeah. So those were little things. We kept that money in a separate account. Like, there was some security built around this. But we're going to get into the nitty gritty on this in a minute, but let's fast forward to the end. What was cool about doing this deal is, my business, outside of people who are in my industry who work for this company, every other human being, you're one of the 5 to 10 people in my life who understands it the best. And you didn't even understand it, like, getting into this. Mm-hmm. Now you've seen me in action. You've seen our team in action. You know what we can do. If I bring you another deal based upon this one and some of the hurdles and the curveballs that were thrown at us, you can understand that. Yep. So, like, I knew. How many times prior to this deal had I ever asked you for a penny? No, never. Ever. Yeah. So, like, I waited and I played that card patiently because you have the ability to invest. You have plenty of money to invest. I didn't want to do that. Like, I wanted to pick the right deal and set it up the right way. And I waited. It's kind of like one of those morsels that kind of pops in your head and you just wait years and you're like, I need to utilize that skill. This was the time I thought to take a shot, because it made enough sense. In the 40-70 rule, I was real close to 70. Yeah. Yeah. So I'm asking you questions, even though we got sidetracked there for a bit. When you took, like, there was a moment for me where I went from selling you to we were on the same side. Mm-hmm. And, like, to me, that was when we built the PowerPoint deck out. You remember that? Like, we were on the phone together and I kind of sent you a bunch of stuff and you're like, cut this, do this. And we kind of started working on it together. Cleaned it up a little, made it a little simpler. And the other thing was, this is a big deal. This is my business. My name's on the door. I understand it completely. You had to raise the money. It was part of our deal. Yeah. So my voice meant so much less. Your voice mattered. Yeah. So we had to build this around you. Yeah. And some of the things that I thought were important, you didn't. And it turns out, like, some of the slides that we put in there, like, you're like, I don't know if I should keep this in there, but you'll do it because you believe me. And people asked about it. So it was like, do you remember, like, that conversation and then kind of taking it out to market and pitching it?
Well, yeah, well, the deck that we built was really largely based around who I thought I was going to call. So, for me, when you're in real estate long enough and people know, you talk to people that have money that could invest. When you talk to them, they ask you, what are you up to? You tell them what you're up to, right? I'm doing some deals. Here's what I did. And they're like, I hear that Matt's in with you on that, or I heard Ron's doing it. Yeah, he's in on that deal. Here's the way that one's structured. Oh, he said it's going pretty well. Hey, next one is kind of the way it works. This is once you've done a deal, you talk to people, they say, next one, let me know. I don't call anyone if they've not said that to me. Right. So keep me in mind. That's kind of the
parlance for.
I have money and I would like to invest it somewhere other than the stock market. That's translated, loosely translated. And I keep it in my OneNote. If anyone's ever said, keep me in mind, I have a list. There's over 30 names in there of people that have said, keep me in mind. It's in OneNote. It's a little tab that says potential RE investors. That's it. Right. And so from a sales perspective, I know I have a list of people that I could call and say, you asked me to keep you in mind. That's how I lead with that phone conversation. So the deck, yes, it's important. I need to be able to show them details. I need to be able to give them details, but the phone call is what matters. It's, you asked me to keep you in mind on the next deal. I have one. Are you interested? And actually, with most of them, it started with a text message. And so very funny. So one of the first people that I called, I've taught his son, I've coached his son in soccer for years. He's a great guy, and I know he's retired, a young retired guy. And his son's a great kid, and his wife's great. I've just known him for a while, and I've just coached him. Like, that's about it. We've hung out a little bit socially, but not a lot, maybe at the pool every once in a while. But he sold a technology company 6-7 years ago for
and because I'm
millions.
so tech forward, I actually use this tech.
You actually are a customer. You are very tech savvy. When you say you mean Kava companies.
All the millennials that work here
all the millennials do it. Angelo. I texted him saying, hey, you told me to keep you in mind. Next deal I had. This one's a little different than the ones I normally do. And I gave him a little bit more detail than a typical text would. It was kind of like 75 units, it's $2 million we're raising, minimum investments, 250, just kind of a general, see what he says. He's the first guy I sent it to. And we kept the text message. It's hilarious. And he writes back and he says, hey, Ian, sorry. Like, he didn't respond. Like, it took like a day and a half later, he didn't respond. I told you he's the first guy I'm texting.
Yep.
I just want to see what happens. Remember. He's got plenty of dry powder. Nothing for a day. I'm like, well, that didn't work. I thought that normally works better than that. Day and a half later, I get a text back from him saying, Ian, sorry it took me a while to respond. I'm on a boat.
I'm on a cruise with my family.
Yep, I'm on a cruise with my family. But this sounds good. I guess I'm in for 400, up to 400. And I texted that to you, and I'm like, here's the way it gets done, Frankie. I haven't even talked to him. I got 400 already lined up.
And it was one of those. It was one of those texts that's coming in, and I couldn't tell who it was. I just texted you the guy's last name with a bunch of question marks, and you're like, "Yep,
yep." We'll talk later. I just texted my way to 400, but I ended up not giving him 400 because we made it a minimum of 250,000. And that is a luxury that we have. Most people can't do that, of course. But the reason we did that is we didn't want 40 people in this deal.
Yeah.
And the reason we did it is because we could.
Yeah.
Right? We could have done it. And actually, there are a few people I could have called that would have given us the whole $2 million, but I didn't want to talk about the structure. I just knew that they would have an issue with you getting the money up front. I just knew there were some people that would have issues that could have given us a lot more money, but their attorneys would have got involved. And so I think choosing the investors was important, but he was one, a tech investor. Another friend of mine owns a very successful chain of restaurants, has done very well. I knew that he would respond well. Friend of mine is a senior partner at a big consulting firm. I obviously know some other executives that were at my level at MVR, and MVR stock has done really well. So I had a number of people I could have called there. And then my boy, who's a big time realtor in Indiana, which we will talk about in more detail.
We'll get into him in a minute. But so what's funny to me about this deal is you were responsible for raising the capital. And this deal actually had a $100,000 minimum, not a $250,000. Keep is $250,000.
Oh, okay.
But that's the difference in this deal for us. I had a note card printed that I carried with me for every day of this deal that I looked at. Every day I thought about who's in the deal, how much money they were in the deal for. Like, I knew that detail because ultimately the performance of this was on me. It was up to you to raise it, but I knew every granular detail. Like, I could tell you there was 2 investors in for 2, there was somebody else in for 100. I was in for half a stick, as they say on billions, and like which I think is really interesting. But what I think is fascinating about what you just said is the concerns and the upfront fees. And we're going to get into this a second. I think we should do it now.
Sure.
Like, who did we not want to go after? We didn't want to have 40 people in the deal. We said that because it's a lot of management. And then who else didn't we want to go after? Like, there were people who would say no to the fee, but we kind of wanted to pick people. I'll do a leading question. We picked people who we knew would say yes, more or less, who would understand the deal. And we really wanted to work with, like, people who would either talk to you about it and were like, hey, let's try this out. Or it was people who, it's people who we know would be like, I'm investing and I'm going to kind of let it set it and forget it.
Yeah, I think because it's an out-of-the-box deal, the way we were structuring the entity and the way I was involved, the way you were involved, people knew you as a guy that had come out with us for drinks before, but didn't know your business for a hole in the wall.
Right.
So needed to understand some of that. So I tried to choose people that knew you, and I tried to choose people that weren't too close to the residential real estate space that you're in, that would say, why are you structuring the deal this way?
Sure.
Because that's not how I would do it.
That's
I didn't
right.
want anyone like that. I didn't want anyone who would be questioning the execution. And that's not to say that that's bad in all deals. For this deal, I wasn't interested in calling people like that, which I could. And in a future deal, I might call if it's structured a little more conventionally, I guess.
And let me state it this way too. This was your first time doing this deal. So you believed in me, you believed in the asset class, you thought we were going to perform or you wouldn't have done it. But at the same time, if someone asked you a question in September of 2019 about this deal, and they ask you that same question now, like, what is your level of certainty in getting it right now versus then, or understanding, or being able to speak educatedly about it?
It's much different because I know the names of the people who are executing better.
Right.
I knew of Eddie. Obviously I know Angelo. I've gotten to know Cindy and Carla much better now. I know
You've
your
been to our
staff. I know
office, we've
Derek.
driven
I know
around.
the staff better. Yeah. I know I've been in the office enough where people know me as your gregarious buddy that comes around and makes fun of you. But I think now I know them more from a context of I've watched them go to work.
Yeah.
And I'm confident. If I were to go promote again for a deal we did jointly, I would be promoting them almost as my team. Like,
right.
Before I was like Frank's team because I didn't know him well enough. But now I'd be like, no, my guys are good in Cabo. Like, I think I would promote it more personally than I did the first time. I didn't promote it personally because I didn't know them personally. It was more, look, I've vetted it. I've looked into it deep. I trust Frank very well, and that's it. And I think it's worth me bringing up a huge part of my stress in the first 60 days. When you're raising money, closing a deal for me for this deal was not terribly difficult. It didn't take a lot of my sales skills. Sales skills are calling someone who's never talked to me before and closing them on the phone. That's cold calling.
Right.
That's tough.
Yeah.
And that takes skill. That takes repetition, practice, all of that. This was leveraging 20 years of trust in me, of success I've had. What was scary for me is there's really only one person who dove into that PowerPoint deck. We put all that work into that PowerPoint deck. I'm pretty sure Tim never read it. I know Pax never read it. Ori probably looked at it a little bit, and maybe we got to beep out some names. Joe maybe looked at it. My boy, the partner, he was all over that deck. And he had lots of questions.
And
right?
so him and my brother.
And that was the point where it was kind of like, and I wanted to be like, look, if it's too much, don't do it. But he needed to get comfortable, and that's fair. But the rest of them were like, you like the deal? And so that's really stressful for me when it's like, I didn't read the deck. Tim, I didn't read the deck, but you like it. You make good decisions with your money. That's kind of the way that deal closed, right? You trust Frank. He's got a good team. This isn't going to go bad. I just lost a ton of money on this. And he told me about some deal he just made that was bad. And he goes, but it's you. I trust you. And I remember being like, hey, Tim, read the deck. I need to know you looked at it.
Yeah.
If this doesn't go right, I need to know that you didn't just blindly toss 250 grand at me in a wire. I need to know that you read the deck, right? After that, I understand you're pretty much in this because I'm in it. And it's funny, the whole deal, I was in it because you were in it and you were saying, trust me, I feel good about it. And I knew part of the reason why I had to drill you is I knew the guys I was going to call were going to say, do you like it? Why do you like it? Is your money in it? All those answers are yes. They were going to say yes if I called them because I went 6 for 6 on who I called. And we had to bring some of them down because I wanted you in it and your brother, right? But we could have got the 2 million just because of that.
There was some strategy. We also knew that if we did a good job for 8 people, those 8 people would go sell 3 or 4 people each next time. We wouldn't have 8. We'd
That's
have
the idea.
24.
That's the idea.
But this comes all the way back to high school football. And what my high school football coach told us constantly is practice is going to be harder than the game. And what you did is you put me through practice. You asked me tons of questions, hard questions. We spent hours and hours. Like, I think before you started pitching, you came down and I think you came and visited and we drove stuff and you kind of understood it. And then when you went to pitch it, you knew it. Like, you were prepped. And so you put me through your paces.
More than that, you went through the entire pro forma line by line with me. Every line, every house we went through. Do you remember it was 3 hours with Angelo? You went through every house.
Right.
Where's the fat? Where are you padding it? Where could this go wrong?
So what I think is critical to talk about, like usually we do this podcast alone. Like, we have a room of people and I've talked to almost everybody who's in this room individually about what happens with deals in real estate. And it's, most people are full of shit. I've said it several times today. Most people don't know how they're talking about. Most people don't vet a deal like this. And ultimately what happens when people invest, especially people that are in your circle, they do it because you're doing it. So if you don't feel 100% or don't, we took that. I think what we learned about each other in this deal is we both had a high level of respect for the other person. But we really learned the details and how we analyze and the integrity and you're I can't lose these people money and you're emotional about it. I'm like, Ian, I don't have the relationship you have, but there's no way in hell I'm losing those guys money. It's not going to happen that way. The first person to get a haircut is me. And those are the little things that we kind of work through. But it's really important to understand how the sausage is made before you go out and sell the sausage. And I think that's one of the things we really want to iterate here is I'm really good at this business and understanding the asset class. I know the market. And Ian felt that way because when you're structuring a deal, most people who are listening to this who might be structuring a deal, you're going to work with friends and family. That's how it starts before you get syndicated and go out. That's how it works. So let's get into this.
And I also think, Frank, all of that negotiating with you, one thing I'll add on this on closing is I anticipated what the sticking point was going to be. Obviously, you're taking all your profit up front. That's highly unusual. Yeah. Right, in a deal. You're getting paid, and then, by the way, we're going to do a deal. I knew that was coming, and so no investor said Frank's brother needs to get in and Frank needs to have capital.
You used it ahead of time.
No investor said you couldn't have those fees in there. I just did all of that, and then I went and said, I know what you're going to be concerned about, and this is what I'd be concerned about with you. Frank's taking a lot of his money. Let me tell you exactly where his skin in the game is. He gets his money out last. He had to put an extra $500 in, and his brother is now in the deal. He has no fees after this happens.
That's right.
I laid all that out. This is what I've negotiated already because I was concerned that the risk wasn't as high on Frank as it would be on us as investors, and that's why I put my money in it. And then it was there was no conversation about the fee anymore up front.
It's Eminem in 8 Mile.
Tell these people something they don't know about me. That's right. That's right. That's exactly right.
You just get it out early.
That's right.
So you already answered the did anyone say no? Everybody said yes because you picked the right people to call and you got ahead of it.
Yeah.
How did you think about dollar amounts per investor? We talked about somebody was in for 100, a couple of people were in for 2, somebody said they were going to go in for 4. I think it's worth belaboring slightly why we did it this way and why we essentially put a cap.
We did lead with 250 with everyone. That when I went out with some of it, one of the investors wasn't as comfortable. When we talked about it, we thought this is a person who in the future is going to A, have more money, but B, has a very strong network of other people in their position
right.
that he will, and he's since done this.
Right.
So
On another deal.
He's since done this. He invested in the tech company that we're in. He's already started telling his boss and other people about how good this real estate deal was. So that was smart. And then Paxton's the other one that came in 50 less, and we'll get into his story at some point.
Yeah, and my brother ended up coming in for 2. So we made the deal work, but we also capped on the upper end at that period in time. Your buddy that owns the restaurants may have come in heavier, but we asked him, no, we don't need you to. And the guy that sold the tech company, he was willing to go 4 out of the gate, and we're like, let's mitigate a little bit of the risk.
I was going to do 4 when he was going to do 4.
That's it.
And I brought mine back down because we thought, let's have a few extra people in this deal and do well with him. Because I was starting, it was building momentum, and I was getting more excited and confident by the day. So I thought, why not have a few more in, because they could be our best salespeople in the future with referrals.
What expectations did you set with the investors, months and percentages?
So, when you and I talked behind closed doors, you thought in 18 months you could get to a 30%. And we had some pro forma numbers before the pandemic that were significantly higher. We were enthused about, look, I got this much padding, I got this much, and we'll get into the pandemic. But I tried to keep expectations lower with that group. And I told them, look, it would be great if we could get a 15 to 25% return within 24 months.
Right.
I was consistent with everyone, 15 to 25% in 24 months. And here's the downside. And most people were pretty comfortable with that return with their money.
Right. And then there was the way that we structured the deal. There was with this deal. These kind of deals aren't, you don't write them on a cocktail napkin. Like ultimately, the operating agreement is pages long. So there was a waterfall structure, blah blah blah. I don't even think we even need to get into
in essence, the first 25% all went to the investors. The first return, it's like a pref, right?
Yep.
That's the pref return. And then in tranches of 5%, they started giving more of the profits away to me and you. So
That's right.
They still got a lot of the 25 to 30, but over 30, you and I were starting to get the lion's share of the profit.
That's it. And we talked about this a little bit. So there's risk and there's debt and there's other things. So the way that we structured this in the entity, I was responsible for the debt. You were the manager, but I ultimately had to give the personal guarantee, which I volunteered to you. Like how you took things out of the deal and crossed them off for the investor. I made sure when I brought it to you, hey, I'm taking the debt. I'm taking the guarantee. I'll deal with those things. We talked about some of the returns. I felt so comfortable because the market was hot in January and February. We closed this deal basically Christmas time of 2019. And I thought in February, March, I thought we were going to be done. I literally thought we could sell this whole thing at a 40% margin before Corona hit. And then Corona hit and the market dried up completely. Yeah. We had to go crazy to get this done. But I knew there was enough skin in the game where we could ride it out if we needed to, and we could kind of land there. So we had said, hey, we can do this deal in up to 2 years, 25% pref. And let's just tell everybody where we landed. We landed at what percentage and how long? So
we finished at a total entity of 30%, which meant that the investors' actual payout was 28% in 13 months. So that's right. We smoked what we told everyone they were going to get to the point where they were just all elated. They were so enthused with what we were able to do, especially when they went through that summer thinking, man, my money just kind of went up in smoke. So we were going to kind of get into it and we did it. So I think this is worth going into because this is really funny, right? So Ian's a great writer. He writes for Forbes. You see him on LinkedIn and all these other things. And this is hysterical to me. So this quarterly update went out on April 3rd. So this is it. It's hello investors with an exclamation point. I forgive you if you needed a few days to get the courage to open this email. I considered sending this on the first of the month, but felt an investor letter on April Fool's Day was in poor form, considering the circumstances. I imagine the timeline of your March went something like this. : great punctuation, by the way. March 11th, Tom Hanks gets coronavirus.
March 12th, NBA cancels season, Dow Jones Industrial falls 1,800 points. March 13th, you remember that you invested in a real estate portfolio bringing on flu-like symptoms.
So leading up, when did I write that? April
3rd.
So deal's going pretty well, and Corona hits, and there wasn't a day in March that Frank and I weren't talking for an hour or two all day about multiple things. But in essence, what happened is the entire real estate market dried up, and no one did anything for 2 months. It panicked, right? And not even just people weren't buying, but
Capital One.
You couldn't get an appraiser to a house. You couldn't get construction folks into houses. The permit offices weren't open. The government offices weren't open. You couldn't get the Section 8 vouchers. Everything that could go wrong was going wrong in March. And we were trying to stay calm. And so I'm getting text messages from the investors like, hey, this pandemic crushing us. And, I'm trying to use some humor to deflect it because I know, look, if we can survive a while and keep collecting rents, we'll be okay. But that first investor update was a couple of pages long. It was
4.
I gave them incredible amounts of detail of what we were doing to mitigate the circumstances and the situation that we were in.
So one of the things that we've talked a lot about today is the power of relationship. And I think something we haven't talked about that's critical is the power of communication. And we're both fairly blunt. I'm told that you're blunt. I'd rather be blunt and just get it out there and get it over with.
Yeah, it's better than passive aggressive.
Yeah. So what we did, and we talked about this, we started talking about it in the middle of March, we all have to show up with masks, is where are we at with this? So I'll start with humor. So I have a 2-year-old, and anyone who listens to this knows this. And Ian is a big baseball coach, loves baseball, loves spending the time with his son. His son's IJ, so my son's Max. So having a conversation with Ian that Max was starting to throw a ball. And Ian's like, Frankie, when he's 9, I'm coming down there. IJ and I are going to buy a house, and we're going to coach Max on baseball. It's going to be incredible.
It's going to be all state.
Incredible. And I go, Ian, why would you buy a house? You're still going to own 75.
Still going to own 75 in 8 years?
Yeah.
I'm like, too soon, Frank. Too soon, Frankie. Too soon. Let's sell one of them, please.
Right. So we started getting, if I wasn't laughing, I'd be crying. So what we started to talk about was the things we can control. And Ian told a funny story. And then immediately we told the investors, here's the ugly. Here's the bad. And we went through and kind of looked at this. And we said, hey, we built this portfolio that if we have to, we can rent it. We can rent every door. We'll collect rents. We might not get as much as we want, but this is why you don't invest in the stock market, which just dropped 40%, by the way. This is why you invest in real estate. And we've got pros on the ground who are collecting rent. We might get bloody, but so be it. This is why we're in this deal.
And look at that in a 4-page email. It starts with humor, of course. Try to deflect a little bit, but the truth is, out of all of those pages, the first 3 pages are the ugly and the bad.
Yep.
Because if you're an investor, things are rough. And so if someone starts with good and roses, my antenna's up. But if you lead with, here's all the havoc going on right now that we're dealing with, and by the way, there's still some good, and we're going to keep being honest with you and transparent, but let's not panic. And I told a story about a baseball card that I bought when I was a kid, and I thought the world ended because the value dropped on it, and by being patient, it ended up being worth more. And tried to give a little bit of an analogy, but I think when you have investors and when you have customers and you make commitments to them, and things are not going right, they know it, and you might as well lead with it and be as direct and blunt as you can about it.
Yep. So this is in March, and this was literally, for those of you looking, or if you're just listening, it's 4 pages. It's 4 pages front and back. We were on the phone, you wrote it, and I'd still be writing this if I was the one responsible for writing it a year later. But you wrote it. It was a lot of detail. We spent almost 2 days on the phone getting prepped to write this.
Yeah, that was another one just as much as before the deal where I'm like, you need to give me details because they're going to ask me. So
everything.
Let's get it all out there.
Yeah. And we were fortunate. When we started this deal, and this is something we learned, we started strong. Like we started strong before the pandemic. By the time the pandemic hit, we'd already flipped 25% of the units to higher rents. We'd already sold 3. Those were things that we had momentum. And because we'd already flipped 25% of the doors to a higher rent or gotten rid of it, our debt came down a smidge, but we were already collecting enough rent and we had good tenants in place. We're like, okay, we can weather this sucker. The other thing you reference in here, and why did I raise equity? There was $750,000 in cash in the account when we wrote this letter. Like our mortgage, that would have paid the mortgage for probably 15 months. Like we had
cushion.
We had tons of cushion, and that's how we built the deal. And that was what was brought up in quite a bit in our prep. So I think
it's worth going back to even just a little bit, just a lesson that we both. So one, yes, we diffused the situation with some humor.
Yeah.
We had a little bit of fun with it. But the truth is, you can only tell so many jokes before people start to say, no, am I getting my money back?
Right.
You have to execute, right?
Yeah,
you have to
very
execute. You have to communicate well with investors if you're going to do this. If you're going to syndicate, you have to. You have to make them feel like they're insiders, like they're in the middle of it, that they know everything so they don't panic. But you also have to execute, and you were doing that well. That wraps up part 1 of Anatomy of a $10 million Deal. Tune in to part 2 to see how we did on the execution of this project, how we managed all the way through the pandemic, all the way to closing, and how Frank and I celebrated. We'll also get into the metrics of the deal and what kind of profit margins we made.